Solana company, ticker HSDT, just widely missed Q2 consensus. I mean, they reported $2.5 million in revenue against a $2.9 million street expectation.
Yeah, and the EPS was brutal. A net loss of 38 cents per share, which completely blows past the estimated 2-cent loss.
Right, and management held off on any formal revenue or EPS guidance, too.
They did note that validator-related revenue will start hitting the books in Q3, but, the market didn't really wait around for that.
No, they didn't. Shares fell 5.56% in regular trading, closing at $1.70, just a tiny after-hours bump.
Exactly, and the sell side reacted immediately. Like, B. Riley slashed their price target down to $2.50.
So that brings us to the mission of today's deep dive for you guys. We are digging into HSDT's latest earnings and management commentary to figure out what's actually happening under the hood.
Because taking a legacy medical device business, ripping it down to the studs, and going all in on crypto infrastructure is it's a massive, wild gamble.
Right, like is it actually paying off or are they just incinerating cash? That pivot from medical devices to crypto is really what makes these numbers so fascinating.
Oh, absolutely. When you look past that top-line miss we just talked about, the unit economics reveal this violent structural mutation. Like that 2.5 million in revenue,
Yeah.
it was driven literally 100% by Solana, or SOL, staking.
Wow. Right, they earned over 31,000 SOL. And they hit a 6.14% net staking yield, which actually beats the network average.
Yeah, and because the direct costs of staking are basically zero, they're boasting this staggering 97% gross margin.
Which sounds amazing, right? Like you hear 97% gross margin and you think, okay, they're practically printing money.
Right, but
But here is where I really have to push back. How does a company with near perfect margins post a $30.3 million net loss in a single quarter? Like, are they just burning piles of cash?
I know it looks like a massive contradiction on the surface, but
Yeah.
the gap between those numbers really comes down to the reality of dealing in volatile crypto assets.
Oh,
Plus, the heavy cost of cleaning up their past. So a huge chunk of that net loss, like 25.4 million, comes from realized losses on SOL sales.
so it's a non-cash digital asset fair value swing.
Exactly. It's just part of their capital allocation strategy.
And then you have the G&A expenses hitting 11.1 million.
Yeah, but the key to understanding that specific expense is that 6.8 million of it was a one-time severance hit.
Wait, tied to the old business?
Yes, exactly. Tied specifically to finally divesting that legacy medical device business, they are basically paying the ultimate toll to permanently shed that old identity.
They really are just burning the boats. I mean, on the call, management was hyper-focused on this new institutional bet.
Yeah, they kept bringing up their new operational flywheel.
Let's actually unpack that for a second. How is this flywheel supposed to work? Because it's not just a corporate buzzword here, right?
Right. Well, a true flywheel builds its own momentum. So for HSDT, it starts with running network validators to generate yield.
Okay, makes sense.
Then they use that yield to build up their corporate treasury. And finally, they use their track record of managing that treasury to advise other institutions.
Which ideally brings in even more third-party crypto to stake on their validators.
Exactly, starting the cycle all over again.
And to be fair, they are putting actual points on the board with this.
Yeah.
Their first institutional validator cluster is live in Tokyo.
Yeah, and they just secured 500,000 SOL and third-party stake commitments.
And didn't they buy a Hong Kong trust company too?
They did, to anchor their expansion in the Asia-Pacific region. Plus, they're repurchasing stock, about 2.3 million worth, capitalizing on the fact that they're trading below net asset value.
Okay, so they're making really aggressive moves. But looking at the sheer scale of the losses versus the operations, I have to ask this.
Yeah.
Is this flywheel actually building a defensible moat? Or is HSDT just a highly leveraged proxy for SLO price volatility, disguised as an infrastructure play?
I mean, that is the ultimate question for anyone looking at this stock, because the risk here is entirely structural.
Because they are so heavily reliant on SOL's price stability.
Right. If the token's value tanks, their treasury takes a massive hit, and it doesn't matter how good those 97% operational margins are.
Wow, yeah. And we can't ignore what's lurking on their balance sheet. They have a $4.2 million level 3 put option derivative liability.
Which is a really dangerous detail. Level 3 means these are highly illiquid assets.
Super hard to value.
Incredibly hard. So if Solana goes south, that liability becomes this massive, unpredictable anchor dragging down their cash flow.
And if the underlying asset doesn't hold up, All that institutional adoption in Asia won't patch the holes in their balance sheet.
It won't. It's the ultimate tension between operational progress and token risk.
It leaves you with a serious question to ponder long after you close the spreadsheet. Can HSDT's first-mover advantage in Asia-Pacific actually outpace the brutal reality of their cash burn and the inherent volatility of their token?
Or is the infrastructure just a house of cards built on top of a highly speculative asset?
Make sure you follow the show for your daily earnings deep dives so you never miss the underlying story behind the headline numbers.